Okay, good afternoon. Good morning, everyone on the West Coast, depending on where you are. My name is Brett Davis. I'm the Senior Vice President here at Exeter Trust Company. I oversee trust operations and custody operations for the group of companies under the Exeter Group of Companies. Today, we're going to speak about some important topics to the world of alternative investments, to the world of real estate, and to the world of retirement planning. And this presentation is geared toward investors who work with real estate and real estate investment vehicles. We also are gearing this toward those individuals who support, service, and advise them. CFPs, accountants, attorneys, advisors, and the like. So we make it very broad for everyone today. Okay, next slide, please. Okay, today you're going to hear from four individuals with between 80 and 100 years of aggregate experience in the financial services industry and investment industry. It's a good amount of experience and age as a couple of us. You'll hear from Matthew Sandretto and Alisa Kolodizner. Matthew is the Chief Investment Officer and Alisa the Managing Director at Prairie Hill Holdings. They're also both founding members. Prairie Hill is a firm offering investment in the triple net lease space in real estate. And most of us know a very important space and profitable area when managed correctly for investors in retirement plans and outside of retirement plans alike. William Exeter is the CEO of the Exeter Group of Companies and of Exeter Trust Company, which offer, amongst many services, 1031 exchange intermediary services and self-directed retirement plan custody services with an eye to investments in alternative assets. Okay, next slide, our purpose. So I touched on our intent briefly, but I want to give you a better idea of what to expect in our presentation today. We're going to first discuss the President's executive order that was created in August, referred to as democratizing access to alternative assets for 401k investors. And I'll explain why we're going to discuss that in a second here. We're going to review types of real estate investments and strategies that are permissible in retirement plans. We're going to discuss the merits of real estate funds as retirement plan investments and the executive order, how it will fuel this. We're going to have a very focused discussion from Prairie Hill Holdings on the merits of triple net lease investing in commercial real estate properties. And we're going to head into home base with an outline of the value of 1031 exchanges and how they can work in conjunction with real estate investments and firms. Okay, next slide. Little bit about Exeter Trust Company before I start on my piece. So Exeter Trust Company is licensed, regulated, and audited by the Wyoming Division of Banking. Put differently, we have a Wyoming banking charter. We're an independent trust company, and regulation is important. Many 1031 intermediaries are not regulated, but ours is through our trust company. And our trust company is regulated, which means we have access to the best knowledge capital out there from other trust companies, and our controls and procedures have been reviewed very intently by banking regulators. So it gives us a level of stability beyond those that are not regulated. We have all the typical insurance coverage, fidelity bond, errors and omission, and financial institution blanket bonds. Finally, Exeter Trust Company offers self-directed IRAs and single K 401k plans. And then we offer other specialty holding trusts, such as specialty holding escrows, land trusts, some personal trusts if they fit our array, And then finally, we're working to get into the fund administration and custody business for private real estate funds. We also hold cash balance plans as a custodian. Okay, so let's talk a little bit about the executive order and why it's important. On August 7th, 2025, President Trump signed and activated an order titled Democratizing Access to Alternative Assets for 401k Investors. Order was driven and focused on investors in employer-sponsored retirement plans. And the order made a couple of distinctions, some important ones. It made a distinction between wealthy Americans and government investors who have always been and previously able to make investments into alternative investments in a pretty easy manner, right? And then it made a distinction between everyone else, right? Who average American really struggles to get into alternatives due to high barriers of entry or just general apathy and dislike from plan trustees to let them in. The order also cites regulatory overreach and opportunistic litigation as reasons retail investors have not reaped the benefits of alts. And we all know this. If we look back over time, the alternative space for retirement plans is a very litigious area. And the order is very clear that there's been opportunistic abuse here, and it wants to open this up and offer protections in place for plan trustees and others in the alternative space. Finally, the order compels the Secretary of Labor and the SEC to work together with some very distinct guidance as to how to get this done. Okay, next slide. So I want to talk a little bit about the order and the momentum behind it. So it continues to gain momentum, right? It made a big splash when the president signed it and activated it. But trailing right after the activation of the order, the Council of Economic Advisors wrote a white paper called Retail Access to Alternative Investments via Defined Contribution Plans. The white paper spoke very highly and put alternative investments in a very good light. On August 20th, 2025, the Committee on Education and Workforce wrote a letter to the Employee Benefits Security Administration urging it to move forward quickly with any guidance received from the SEC on opening up alternatives on their space. So two very large organizations supporting the order. Finally, we have Representative Troy Downing introducing the Retirement Investment Choice Act, I believe in October. There's kind of mixed reactions around whether this will get any momentum. However, it demonstrates that there's a lot of energy at the political level behind this executive order. Next slide, please. So I want to talk about something that's in the order which makes it a little different from other orders. It makes it very political, very social, very cultural. My administration will relieve the regulatory burdens and litigation risk that impede American workers' retirement accounts from achieving the competitive returns and asset diversification necessary to secure a dignified, comfortable retirement. This tells me a lot. Next slide, please. The order is not going away. It's going to get a lot more support. And in the end, for all of us, it's going to open up the world of interest and possibility for alternative investments in not only employer-sponsored retirement plans, but individual retirement plans, such as IRAs, Roths, Simples, SEPs, as well as other plans. So it's going to make a very big splash once the SEC is able to move forward. We talked a little bit about kind of the political frame of reference here, but there are some anticipated effects of this executive order that are fundamental and technical in nature. First, when you add alternatives to investment portfolios, asset diversification potential is improved a great deal. And that addition of the additional asset that does not correlate to the markets um, improves the risk return ratio in employer-sponsored retirement plans. Most CFAs, CAIs will agree with that statement. It's going to also create general interest from individual retirement investors. I already spoke to that. And finally, those rolling over from retirement plans due to severance, due to retirement, are going to be looking to private funds for additional investment opportunities, which continues to open up the world of potential for fund managers and private funds, custodians, individuals, and everyone involved in alternative investments. Okay, next slide should be types of alternative investment real estate and IRAs. I'll talk a little bit about the types of real estate investment that could be done in IRAs. I want to caveat this with the fact that there are some prohibited areas that IRAs, retirement plans cannot stride into when investing in alts. But that's beyond the scope of this presentation. We will have a Q&A session at the end where questions can be asked around that, but I'm not going to touch on those. So first of all, retirement plans can take deed to actual properties. These can be retail dwellings for long-term lease and rental potential. You can invest in an Airbnb, a VRBO, for the potential of renting it out to vacationers who are traveling. Commercial properties are also a possibility. We see investments in strip malls and warehouses. And then raw land for spec, development, game, and mineral production are also a possibility. Finally, there is a piece of debt-related financing that is possible with retirement plans as well. A retirement plan can lend money to an individual or to a company and take a deed of trust back as security. So deeds of trust in IRAs are also a possible real estate-related investment. Finally, pooled type investments. Delaware statutory trusts, real estate investment trusts, BDCs are also possible investments in IRAs. And finally, real estate private funds are possible to invest in IRAs. Next slide, please. So why would one want to do this, right? Plethora of listed securities trading on exchanges, mutual funds, 7,000 of them, ETFs all over the place. Why invest in real estate? Well, further asset diversification potential. Private real estate investment tends not to be as correlated with the markets as other assets are. And that's good when we have a day-to-day where NVIDIA pulls everything down with it. These private funds are not seeing the same effect, right? The fund managers in private funds are focused on finding quality investments in real estate and not looking to their right or left about what the market's doing or having to discuss the fact that NVIDIA's pulled down everything with it. Real estate is not correlated with the markets, so that's a very big point to make. Professional and engaged management of funds is also important. Fund managers for real estate funds are focusing only on their strategies. They're not having to focus on reporting to the SEC. They're not having to discuss the market whims with individuals. Their full engagement, focus, and breadth of experience is on finding and selecting quality properties that fit within their expertise. And there's a variety of types of expertise and focus in this industry, whether it's triple net lease properties, strip malls only, raw land to be developed. The list goes on and on. It's a very broad area of diversification. So very creative models can be created by fund managers in the real estate space. And again, I want to touch again on the autonomy that private fund managers have. They are fully autonomous, freedom of making investments within their level of experience and their vision of range. So Sam Zell said something about taking funds private when he took one of his companies private. He said, just by being private, the culture will change. We won't be forced to make decisions that are 90 days in relevance, right? In a private fund managers can move quickly. They can move definitively, and they can select investments, again, without other areas of stress around their world. And it just creates a better investment experience and return for everyone. So with all of that said, I want to turn it over to Prairie Hill Holdings, to Matthew Sandretto, and to Alisa Kolodizner. They're going to share a lot about triple net lease properties. And again, I want you to focus on how this might work with retirement plan investing, with any serial real estate investing you're doing for you or for your clients. Very important. Alisa, Matt, thank you for being with us.
Thank you so much, Brett, for the wonderful explanation. And thank you, Exeter team, for hosting today's webinar. We're going to turn it over now to a little bit about Prairie Hill. We are a fund focused on private real estate investment. I'm going to start the conversation, and then I'm going to turn it over to my business partner, Matt Sandretto. So Prairie Hill Holdings is a form of a private real estate fund. We are based here out of Lake Forest, Illinois. And if you advance a little bit further, we have been investing over $100 million of assets into specifically triple net. And so today we're going to talk a little bit about the differences too, because yes, real estate is an asset class, but it does come with sub-asset classes. We are focused specifically on the triple net. Our current investors are wealth management firms. We work with registered independent advisory firms. We work with family offices as well as high net worth individuals directly. Those are the different ways, the different investors that can access our fund directly. We do target net returns. And so when we say the word net, what that means is after tax. All of our investments are directly into the real estate properties, which allows all of our investors to receive the tax benefits that we do provide for our investors through active depreciation. So our target returns are 15% net returns. And with that, we do produce over 7% cash yield, all net. We pay out on a quarterly basis. So we are considered an income source for our investors. And the way we achieve these results is through not just triple net, but specifically into industrial triple net, into necessity retail triple net, service-oriented education, quick service restaurant, and medical as well. So we do have a diversified portfolio that our investors own within triple net. So the next slide, we're going to talk a little bit about us, who we are. So my name is Alisa Kolodizner. I am the co-founder, managing director of Prairie Hill Holdings. A little bit about my own background. I have invested in private investments over $90 million worth. Prior to that, I had my life in the wealth management space where I was a financial advisor. So I am a certified financial planner. I work as a fiduciary. I've worked with over $3 billion worth of assets under management in the wealth management space. And I specifically worked with clients that custodied through, at the time, TD Ameritrade, and now Schwab. And with that, I'm going to turn it over to Matt to introduce himself and one more of our colleagues.
Great. Well, great to be with everyone. Thanks to Exeter for hosting this webinar. So I'm Matt Sandretto, Chief Investment Officer at Prairie Hill. My experience has been in private investments, first private equity, and most recently real estate for the past 5+ years. Before my investment career, I went to Wharton for business school, and before that, I was a pilot in the Navy. If we advance one more, another important person on our team who's not in the webinar today, but I wanted to list him because he's a big part of the investment team, is Scott Milliman, Kellogg MBA, and he actually came from the retail world, having worked at M&A, Target Corporation, and before that, JP Morgan. So we're going to talk a lot about, yeah, we got 45 years of combined experience. So let's dive into it. We're going to talk about real estate asset class, the advantages of it. We're also going to talk about some of the issues in it and how you control for some of those issues and risks. So first, for those who are new to this asset class, and even those that are dyed-in-the-wool real estate investors, we always love to start with the data, because we find that a lot of people are unfamiliar with this, that if you look over the last 150 years, very, very long term, at the largest investable asset classes, so if we say real estate, equities, bonds, real estate actually on an average annual return basis came out on top. This data hadn't been prepared until pretty recently. This paper was published in the Quarterly Journal of Economics, kind of right before COVID. So I think it got buried by the all the COVID hysteria. But that's a big result, because I think a lot of people tend to look to the equity market to get return, and the stock market has been a great source of return over the years, but real estate is a great return source as well. Let's go to the next slide. Talk a little bit about volatility, because let's face it, how you earn the return is important. The stock market is exceptionally volatile, and this data shows that over the last 150 years, on average, the equity market had 22% volatility on average, meaning if the market's down 20% plus in a year, you shouldn't be surprised. You should expect that. A more surprising result, I think, that this data shows, is that real estate is actually very, very stable. In fact, comparable to government bonds. So with that, you have to say this is an asset class that you can't ignore. It really does need to be something that you consider, and it should be something that's in your portfolio. So that's the rose-colored glasses side of real estate, right? There's risks and there's issues as well, and things like rents and valuation. If you invest in a property that has rents that, let's say, are above market rents, and you lose the tenant, and then you re-tenant the property at lower rents, your valuation is going to go down. You're going to lose money. That's an area we see a lot of investors they're not very careful about that risk. They're not really looking at what are the rents in relation to market in the investment in question. So that's incredibly important, and that's a big risk that has to be managed. Insurance, property tax, maintenance costs, these are on the expense side of the asset. And then unfortunately, insurance is something that I don't think anyone was really talking about 10 years ago. But today, the year-on-year increases in insurance premiums have been significant. I mean, we're talking 10, 15% increases, in certain cases, 20% increases. And that's something that's eaten away at the bottom line in a lot of cases for certain real estate types. Property taxes, we all know that most local governments across America are now becoming more responsible, and so property taxes tend to go up over time. Maintenance costs, those have exploded over the past couple years, with both construction costs being materially higher than it ever was, and same thing with ongoing maintenance. A lot of people fear real estate because of management. You got to have a plan for management. Sometimes outsourcing property management is very expensive and eats into the return. But at the same time, people don't want to deal with it themselves in a lot of cases. The property types in real estate are very diverse. And where we're going to go from here is kind of show you that some of these issues that we're talking about, they can be controlled by investing in certain property types versus others. Let's go ahead to the next slide, please. All right, we can click through and show the different types. So the big investable property segments in commercial real estate are multifamily, office, industrial, and retail. And where should you focus if you want to avoid some of the things that we were talking about? We're going to argue that you should focus on things based on the type of lease that's in place, and you should focus in the areas that have net leases as opposed to gross leases. And we'll talk about net leases and what they are, but industrial and retail, those are the property types where you're going to find net leases. And in a net lease, the tenant is going to be responsible for paying or reimbursing the landlord for important property expenses such as insurance, maintenance costs, and property taxes as well. So let's go ahead to the next slide. So a lot of these issues, net lease is going to solve them. All right. Insurance cost is going up. It's difficult to control across the country. But in this case, it's a cost of for the tenant to do business in that location. So it's not going to eat away at your return as a property owner. Same thing for property tax. Tenant's going to pay it, and then maintenance as well. So, vendor costs rising, more expensive maintenance. You're going to be insulated from that in net lease. That is not the case in multifamily and office, primarily because if you think about it, in that situation, the tenant is just paying rent and the landlord has to pay for everything else. So if market rents are at a certain level, insurance is going up, rents, the tenant doesn't cover that. So you just have lower investment returns. The other thing is the type of tenancy that you get in this asset class. You're dealing with large corporates and large companies where the revenues are far higher than the rental obligation. So there's great coverage there, and that creates very consistent income. The management piece. So management remains important. It's always important in real estate, but in a net lease situation like this, the tenant is going to take a much more active role in day-to-day responsibilities at the property. For example, Whole Foods, they're not calling the landlord if there's a toilet issue in the Whole Foods. They're gonna call their plumber, their technician, and they're gonna address it, right? It's not gonna fall on the landlord. Whereas that is not the case if you're managing an office building with a common area or say a multifamily apartment complex. It's gonna fall on you. Duration of the leases. In net lease, you're going to see much longer term leases, which is an advantage for predictable income. All right, let's go to the next slide, please. So looking back on these asset classes, office, multifamily, industrial, retail over the past 15 years or so, you can see that retail and industrial has been at the top of this list for quite some time now. We've got on the next slide, we've got the volatility numbers. Those are the return numbers, but let's look at the volatility. So over the last, this is longer term, this is about 35 years worth of data. Industrial was the highest average annual return. And retail, the two that we want to focus on, was the least volatile. So those two stand out. Now this is data from PRIO, which is the Pension Real Estate Association, and NCREIF. So this is all private fund data that they're aggregating, all different strategies. So it's hard to say, okay, if you invested in industrial, you definitely earned a 10% return. You might have done far better than that, but just generalizing, these numbers are instructive. So we got to invest though, looking forward, right? We can't say, oh, industrial retail did well in the past, so that's where we need to invest, because we always say you gotta be looking through the windshield, not in the rearview mirror when you're investing. So industrial and retail though have great situations going forward. So we're going to talk industrial first, and we'll look at retail. In industrial, there's really three trends that are in play today. First is the decline in construction. So during COVID, There was a strong couple years of significant industrial construction where a lot of square feet were added to a lot of industrial markets across the US. Recently, that construction activity has collapsed, and the forecast for construction is far lower than it's been over the past 5 years. So that's happening at a time where the US economy is still growing strongly, and our forecast is, for strong growth out to 2030. So you're going to have continued growth, but yet you don't have additional supply being brought to market, which is going to increase rents, decrease vacancy. The second trend is onshoring. So if you look at the number of companies in different industries that are pursuing onshoring, that number continues to increase, and that's driving demand for industrial space across the United States. And the last trend is, I already mentioned this, it's economic growth. There's always reasons to worry in the headlines, but I think the saying that bulls make money and bears sound smart is very true. And if you look at the data indicates economic growth, is the best forecast for the U.S. over the next 5 years, and that's going to support industrial. Now I'll switch to retail. So I think this is for those that aren't active, retail real estate investors. When we say retail, we're talking about shopping centers. We're talking about single tenant net lease stuff like, restaurants, quick oil change, all those types of real estate. It's doing very well, extremely well, actually. So retail real estate is setting records. So if we look at some of the numbers, 4.5%. So there's the retail real estate vacancy rate. That's a historic low right there. It's setting records. And across really all categories, it's doing well. Foot traffic is up across the board, whether it's fitness, discount stores, shopping centers, grocery, it's all up. Big reason for this is that retail construction over the past 20 years was pretty much non-existent due to fear that online commerce and Amazon, et cetera, was going to prevent the need for new retail real estate. That's, fast forward to today, we know that's not true, that online is very important, obviously, but a omni-channel approach is the way business is conducted today, where you need a physical presence, but you also need online, you need all these different things working together. And it turns out, with the growth of the US economy, just not enough retail has been built. So if you're an owner of retail, it's a good place to be. You've got, solid rents and low vacancy and a good amount of demand for space if it becomes available. So quickly, we'll talk through just a couple example investments that we've made over the past few years to give you a sense of things that we own and that we've bought. So this property here is a multi-tenant industrial building in the Chicago region, and it's part of it is cold storage. So it's a food storage tenant that is a major tenant in the facility, and we're really excited about building an expansion for this tenant. So their business has grown. They need more storage. So we are in the process of building an additional 15,000 square feet storage, cold storage for them. And you can see this is a mock-up of what the finished, expansion part of the building is going to look like. Multi-tenant industrial, we talked about all the trends, but multi-tenant's great because you have some diversification within the asset itself, and vacancy isn't it's not an all or nothing, all or nothing type of thing. So that's something we do like about multi-tenant industrial. Retail example, this is a shopping center in Tucson, Arizona that we invested in a few years ago. It's a mix of grocery as well as fitness. So Sprouts Market and LA Fitness. And there's also excess land on this shopping center parcel that we're in the process of developing. We're building a Scooters coffee drive-through in the front, which we're about to start construction on that. We've gotten the permits submitted just recently. And then there's additional land by LA Fitness that we intend to develop as well. But these are, what we would define as necessity retail. This really shows that category that, people are going to shop groceries. They need to do that. And fitness has become a staple. And generationally, the younger generations are more committed to fitness than ever before. So that's just something that's going to keep going. I'm going to turn it back to Alisa at this point to talk through kind of the different investment structures and then go through some case studies as well.
Thanks, Matt. So we're going to talk a little bit now about how to access Prairie Hill. And so our fund is available through multiple structures, one of which is the fund directly. So what that means is investors can buy directly into the diversified portfolio. It includes the assets that Matt talked about, and then quite a few more that he didn't. And so they all are triple net, grocery anchored, quick service restaurants, industrial, and retail. They are a diversified portfolio, so that's the benefit of investing into a fund. None of the tenants make up any more than 10% of the overall fund. So it truly is a diversified portfolio. And it can also be invested in through retirement accounts. So, your retirement assets, self-directed IRAs, hopefully at some point, we're talking about the 401ks potentially as well. For now, it is through IRA investments, and it can range. So you can really range in the investment amount that you choose to commit to it. You get a little piece of the overall portfolio. So once again, whether the investment size is 50,000 or 15 million, you are buying into a diversified portfolio. Another way that we work with investors, if you advance, is through 1031 exchanges. And so the first property that Matt showed you, which was in the industrial, we actually did it with a 1031. And so the way that we're able to work with 1031 investors is we can identify, because we have a consistent pipeline of properties, we can identify addresses of how we would do the 1031 with the investor, and we source it directly. That starting point is 500K, and then we're able to include investors into our acquisitions. So, for example, the property that we looked at, it was about an $18 million acquisition. We did it together with a 1031, and so it was the fund alongside a 1031, and it allowed the investor to gain access to an investment class that typically is a lot more difficult to access unless you do have that $5 to $30 million to acquire. On the next slide, we'll talk a little bit about some case studies. So how does this relate to me, I guess is the best way to put it, depending on who's on the call today. If you are a registered independent advisory firm, the reason that you're choosing to work with Prairie Hill, and this is an example of one of the firms that we work with, is they were servicing clients, to be frank, in the Midwest, which is where we are. And at the time, their allocation to real estate was in REITs. And so it was directly through funds like Blackstone. They did focus on 1031 solutions, but they didn't necessarily have the opportunity of directly working with an organization that they can direct their clients to. And the clients would typically invest between 100 to 325K into any of the funds that they were looking to add into the portfolio. They did prefer hands-on approach. And so the challenge that they were finding is a lot of these larger funds, they're not necessarily always buying exactly what and the advisor doesn't have any control over knowing what's going to get bought next. And so the problem with that is they are the ones responsible for the allocation within their client's portfolio. And so when they're adding a fund where they don't necessarily know what the next investment will be, a lot of times it falls out of favor with the allocation that they'd like. And so the current examples that they had were, like the BREIT and the BCRED, they began to question whether those were the best solutions when it comes to getting the diversification in the real estate sector. And so based off of those challenges, what they decided to do was, they did attend one of our webinars, and they decided to invest in Prairie Hill for a couple reasons. And so if you advance a little further, the Midwestern piece, we do focus on all recession-resistant, necessity-based properties. So the advisor felt confident where they knew exactly what our selection was focused on. So what does our due diligence look like? And it was always recession resistant, it was always necessity based. We stick in that lane. We don't look to exit into something separate. So that was one piece. The other was really our tight fee structure and transparency. A lot of times when you're investing into a fund, there's a bit of a waterfall. There's a waterfall for a couple reasons. One is when you're looking to allocate hundreds of millions of dollars, if you'd like to get access to real estate, it is a finite asset class. And so it forces a lot of these funds to invest into other funds, and that becomes a waterfall of fees. There's also less control over all of the different organizations that they need to work with in order to manage the fund. So there's property management, there's debt sourcing. And so with Prairie Hill, we don't have those layers. We do everything direct. The team sits behind Matt in the office there, and it's direct access and support. And so the team does support the wealth management firms directly. We have a team that pre-fills paperwork, that does all the onboarding locally. And so it was a big win for us because it really built a relationship that showcased a differentiator that now the financial advisor was able to provide for their end clients. And today the firm consistently adds new capital, that's one example of how our investors work with us is through their advisor. The other way is individual investors directly. So on the next slide is an example of one of our investors that chose to work with Prairie Hill directly and the reasons why. And so the individual was close to retirement age. They were in a very high tax bracket. So their household income was putting them into a fairly high bracket. And they did have assets in retirement already set aside. However, really what they were looking for was one, an accelerated timeline of really understanding what their after-tax returns would be. And so a lot of times when you're invested into your taxable assets as well as retirement, that tends to impact your taxable situation when you are making withdrawals versus with Prairie Hill, because all of our investors are limited partners, they are direct owners, which means when we do active depreciation, it does offset our cash yield. And so it does provide that tax efficiency. And so that means that the income is a lot more stable. You know exactly what you're getting because it ends up being after tax. And so Prairie Hill did make sense for those reasons. It provides a net 7+% cash yield on an annual basis, distributed quarterly. It did provide that tax shield. And then finally, one piece that is important, and Matt talked about a bit, but the hands-off investment, right? So most investors, when they're gaining access to real estate, it is through potentially rentals, and they are responsible for when the toilet breaks. And so here, by investing into Prairie Hill, it's hands-off. There's no property management or landlord responsibilities, and yet the returns are showcasing really close to, if not more, of what you'd be getting when you're investing directly into the real estate. And then finally, diversification. So beyond stocks, REITs, or annuities in 2022, when the stock market was down as well as bonds, we were up double digits because we are an investment class that is an alternative. And so it doesn't run parallel to the stock market. And with that, I'm going to turn the presentation back over to the Exeter team to talk more about 1031 exchange services.
Bill, you're on mute.
I've been called mute more times in the last 5 years than I've ever been called mute before. But one of the things I like to do is talk about, what really matters, what really qualifies out there. There's lots of confusion. We get people who call us all the time and say, I talked to 3 or 4 people and I got 3 or 4 different answers. So as we go through the quick summary of 1031s, I'll point out where and why there's confusion, what really matters, what really qualifies. And that'll help you make a better informed investment decision for whatever you're trying to do. So Exeter 1031 Exchange Services is a qualified intermediary, or some people call us an accommodator, facilitator. We also serve as an exchange accommodation title holder for those who are doing reverse 1031 exchanges or improvement 1031 exchanges where we have to acquire and hold, or what the IRS calls parking, legal title to the property. So having said that, the quick summary is we do all types of 1031 exchanges. We cover all 50 states. We cover the U.S. territories, and we cover foreign properties. And that's kind of the first area where there's a lot of misinformation out there. A lot of things you read will say you cannot 1031 exchange foreign property. What they really are trying to tell you is you can't sell foreign property and 1031 exchange into U.S. property, and you can't sell U.S. property and 1031 exchange into foreign property. But if you are a U.S. taxpayer and you have a rental investment or business property in a foreign country and you're going to sell that, it's probably going to trigger a U.S. tax consequence. And with that, you can structure a 1031 exchange, but you have to sell foreign property and then reinvest in foreign property. And that would allow you to defer the U.S. tax consequences. So we do the forward 1031 exchanges, the reverse 1031 exchanges. We do improvement 1031 exchanges, and we do zero equity 1031 exchanges. And a lot of folks haven't heard of zero equity. You typically see that in recessionary times where the value of your property drops, it's worth less than what you owe the bank. People assume that because there's no equity, there's no tax consequences. But in a lot of cases, you may have no equity, but you may still have a tax consequence. And there is a way to do a 1031 exchange with that. You just have to get more creative with your solution because there's no equity to deal with. So real quick, I'm going to kind of fly over some of the basics here, but the 1031 exchange is tax deferred, not tax free. A lot of people refer to it as tax free. But it's all about the ability to sell real estate that's held for rental, investment, or business use and not incurring the federal and the state taxes. So it keeps all of your money in your pocket as the investor, makes it a lot easier to trade up in value, buy multiple properties, et cetera. And, a lot of folks will ask us, well, what's the best way to take advantage of it? They traditionally look at the 1031 exchange as a transaction tool. They are selling one property. They don't want to pay taxes, so they do a 1031 exchange. But for those of you who are advisors, you know that it's more than that. It's a wealth building tool. It allows them to continually defer the taxes every time they sell rental or investment property. They do a 1031 exchange. They defer the tax into the next property, and they keep deferring. And then when they pass on, the heirs, whoever inherits their property, will get a step up in cost basis in most cases, which means the capital gain tax goes away and the depreciation recapture tax goes away, and they avoid the net investment income tax, the 3.8% tax that people refer to as the Obamacare tax. So it's all about deferring over and over until you pass, leave the property to kids, grandkids, friends, whomever, and they get that step up in cost basis. So we have a morbid sense of humor. We call it swap until you drop. It's the best way to really kind of keep deferring until you get to death, leave that to kids and grandkids typically, and avoid all of that. So first step, now we're going to kind of talk about the mechanical steps and some of the things we see out there to be concerned about or watch for. One is you want to make sure that you have the 1031 exchange set up before closing. The requirement there is the purchase and sale agreement is assigned to the qualified intermediary. They step into the shoes and become the seller for the transaction. And that's what allows the investor to defer the payment of their federal and state taxes. If the 1031 exchange is not set up prior to closing, even if they tell the closing agent, don't disperse the funds, I intend to do a 1031 exchange, the fact that the closing has occurred means they have the right to receive the funds, and that's what creates the tax consequence. So the 1031 exchange has to be set up prior to closing. There's no way to go back and fix that. And then the role of the qualified intermediary, which is our role, is to really draft the documents, to set up and structure the 1031 exchange, receive, hold, and safeguard the funds during that exchange process, and then really serve as in kind of a consultative nature. You can bounce ideas, bounce strategies off of us to make sure that you stay in compliance with all the requirements. This is probably the most important slide, which is qualified use. So the properties that you sell and then reinvest in through the 1031 exchange have to be held for qualified use. That means held for some type of rental, investment, or business use activity. This is also where there's the most confusion out there. So I'm going to spend a little more time on this slide. First off, rental means you've rented or leased the property out. You're collecting income. It's producing cash flow. That certainly qualifies for 1031 exchange treatment. However, a lot of things out there sound like you have to hold it for rental use. That is not true. You could certainly buy real estate and hold it for capital appreciation. So it can be held for investment. It does not have to produce cash flow, but it does have to be held for investment purposes. You couldn't buy real estate and hold it and use it personally. That wouldn't be considered held for investment. That's held for personal use. You could also buy real estate and use it in your trade or your business. So as long as it falls into one of those three categories, you'll qualify for 1031 exchange treatment. Now, where people get hung up is how long have you held the property? And people will call and say, well, I've been told that I don't qualify for 1031 exchange treatment because I didn't hold the property for at least a year and a day, 18 months, 24 months. And they'll say, well, what really matters? What really qualifies? So the takeaway here is there is no requirement in the tax code, the regulations or rulings that you have to hold the property for any specific amount of time. There's no statutory requirement. But what it does say is you have to have the intent to hold for rental, investment, or business use. So the longer you actually hold the property, let's say as rental property or as investment property, the easier it is to demonstrate that was your intent if you get audited. So that's what it boils down to. Now, investors who are in the business of buying real estate and then doing something to it, and it could be developers, contractors, builders, rehabbers, flippers, condo conversion specialists, they buy, they do something to the property and then sell. They're not holding for investment. They're really holding for sale, like inventory in a real estate business. So those investors don't qualify for 1031 exchange treatment. Now, if they were to buy the real estate and then build or do whatever they're going to do to the property and then actually hold it as rental or investment property, it would qualify. So it boils down to what is the intent? The intent is absolutely critical. And if they get audited, can they show their intent was to hold for rental or investment, or was it actually held for sale? And held for sale doesn't qualify. And of course, anything held for personal use will not qualify either. So, if you're told you don't qualify because you didn't hold it for a certain period of time, that may not be true. It all boils down to what your intent is. The other area that kind of closely related, and there's lots of misinformation out there as well, is like-kind property. And you get a lot of folks who still think that if you sell a condo, you have to buy condo. If you sell a multifamily property, you have to buy multifamily. If you sell net lease, you have to buy net lease. And that is not true at all. It's actually very simple. In a definition of like-kind is if you're selling real estate, which you have to for a 1031 exchange, you also have to reinvest in real estate. And as simple as that. So you have to make sure whatever you're selling and whatever you're buying is considered to be real property. And it includes a lot of different things that you would never even think of, which we'll cover on the next slide. The one thing I just want to clarify again, though, which we covered at the very beginning of my segment, is that if you're selling foreign property, you do have to reinvest in foreign property. If you're selling U.S. property, you have to reinvest in U.S. property. But anything, and let's just stick with the U.S. market, anything that is considered real estate will qualify as like-kind. And you'll see on the list here, it includes things you wouldn't even think about, like air rights, water rights, mineral rights, certain types of oil and gas investments, fractional ownership interests in like tenants in common arrangements or Delaware statutory trusts qualify. We've done exchanges on timberlands and vineyards and billboards and cell site towers and all sorts of things that you wouldn't really think about, but they are considered real estate in many cases. So that's what it all boils down to. Any property that's held for personal use wouldn't qualify, but usage can change. Qualified use can change. So you might be able to stop using it personally, convert it to investment property, season it for a period of time to show that you truly intended to convert, and then it would qualify. Having said that, there's certain mechanical steps we have to follow. So once the closing occurs, it triggers your deadlines. You've got exactly 45 days to identify what you're going to acquire. That 45-day period starts running with the close of your sale transaction. So let's say you close today. Tomorrow is considered day one. You've got exactly 45 calendar days to identify what you're going to acquire. That by far is the most difficult part of the 1031 exchange. It moves very quickly. So that's why it's great to have relationships like Prairie Hill, where you kind of know what you want, you're ready to go. Once the closing occurs, you can start making decisions, etc. Having said that, this is a crazy market. So people always ask, how do I deal with these deadlines? Well, one of the ways to do is, approach the buyer and say, look, if you're making an offer, you need to cooperate. We need a long-term closing. We need options to extend. If they need immediate access to the property, you could lease it with an option to buy, or just say, look, we'll rent it to you until you're ready to purchase and we're ready to sell. So there's different ways of dealing with that. You can look at identifying a Delaware statutory trust as a backup strategy. So a lot of opportunities there. On the flip side, on the property you're looking for, the replacement property, start looking early. I realize it's a hard market. Sellers aren't willing to cooperate today. But if you find property you like, maybe you can do a lease with an option to buy. Maybe you can rent it. If you can tie up the property but not close on it, it helps you juggle all the deadlines and timing that are involved. And then that's your identification period. After your 45-day ID period, you have an additional 135 days to actually complete your 1031 exchange transaction. And that's a total of 180 days. So be careful. It's not 45 plus 180. It's a total of 180 days. And there's different rules in terms of identifying property. This gets a little complicated, but by far, most people use the 3-property rule. And that's because they're probably selling one property and they probably want to buy one property of probably a little greater or maybe even a lot greater value. So they're going to identify 3 properties. With 3-property rule, you don't have to care about what the market value is. As long as you don't identify more than 3 properties, they can have any market value that you like. So you can trade as far up as you want. Then you've got investors who say, well, I want to sell one property and I want to buy 2, 3, 4, 5, 6, whatever smaller assets and diversify. You can also do that. There's no requirement that says you have to sell one and buy one. You can sell multiple, you can buy multiple. Although keep in mind, the more properties involved, the more complicated it gets, especially the identification requirement. So if you're selling one property and you want to buy a bunch of smaller properties, you're probably going to look at the 200% rule. As an example, we had a client recently who sold a $4 million asset, and that was in California, wanted to go to Tennessee and buy a whole bunch of single families. So he identified 56 separate single family properties. The total value of all those properties, if you add them up, was not more than $8 million, which is 200% of what he sold. He sold for $4 million, 200% is $8 million. As long as he doesn't identify more than $8 million in value, he's satisfied his 200% requirement. It's either or, whichever makes sense for you in terms of your strategy. And then the final catch-all is kind of a 95% exception, and that is if you identify more than 3 properties and you identify more than 200% in value, you'll still qualify as long as you actually close on 95% of the value that you've identified. Keep in mind the identification should be sent to us as the qualified intermediary, and it has to be specific. You can't identify, let's say, a condo complex on the corner of 10th and B. You have to identify the unit, the specific address, the specific legal instruction, etc. And then one of the areas where there's a lot of confusion is reinvestment. Investors especially often think all you have to reinvest is your taxable gain, your profit, or all you have to reinvest is the amount of your equity or your cash that comes out of the sale. Neither one of those are true. It's really the top level. So if you, let's just say you sell for $5 million, you can subtract your routine selling expenses. That's going to get you a net sale price of about $4.8 million. That's the magic number. That's what you have to reinvest to defer all of your federal and state taxes. So as long as you buy something in that example that's worth, say, 4.8 or more, then you've deferred everything. You've traded equal or up in value and you're in great shape. So the requirements are trading equal or up in value, reinvesting all of your equity, And then usually people get a replacement, a brand new debt on the new property. They replace the old debt that was paid off with a new loan on the property they're acquiring. However, contrary to what you read out there, you don't have to replace your debt. You can replace the debt instead of other debt, you can replace it with out-of-pocket cash. So you do have to replace it. I kind of misspoke there, but you have to replace it either with new debt or with out-of-pocket cash. Now, one of the things you see on the internet a lot is you have to trade equal or up in value. You have to reinvest your equity. You have to replace your debt, et cetera. And again, as we just said, you don't have to do that. Partial 1031 exchanges are okay. They don't hurt your 1031 exchange, but you are going to pay some taxes in most cases. So some people trade down on purpose. Maybe they sell for 5 million and maybe they find an asset they like for 4 million and they stop right there, ignoring closing costs. They've traded down by $1 million. That 1 million is taxable, but everything else would be tax deferred. So you can trade down. It's a partial. And everything that you reinvest will be tax deferred. The amount you trade down by will trigger taxable gain. Now, you may have something on your tax return like suspended passive activity losses, net operating loss carry forwards, or any number of things that may offset it. So even if you do a partial exchange and you trigger some of your taxable gain, you actually still may not pay taxes depending on your circumstances. So always talk to your tax advisor to see where you land. But the big important point here is make sure that you talk to your tax advisor, understand what the tax consequences are, and then decide if you're going to do a full exchange or a partial exchange. And a partial exchange, again, is permissible. And that is a quick whirlwind tour on the 1031 exchange topic. So I'll turn it back over to Brett, and we can take questions now if there's anyone who has questions out there.
Yeah, it doesn't look like there's any questions right now. I actually do have one to kind of demonstrate a point, and I want to go back to Prairie Hill's slide number 11 at the bottom. You had shown some very telling statistics about real estate's performance. I wanted to confirm, is that just in the Illinois area, your region? Or are we talking national here?
Uh,
You had
yeah,
it there,
I just want to make sure we're talking about the right one. That slide right there, that's
Nope.
national.
This one here.
Number 11. Two more down.
We're down. That one?
Yes,
Bingo.
that's all national. That's right.
Okay.
US only. So not globally, but US.
Yeah. So to point out, this is across the nation, wherever you're investing in real estate, there's probably some regional nuances, but wherever you're investing, you're seeing some potential for real returns here. It's across the nation, and I think that's telling for people in retirement portfolios as well as external. Second point, since we have no questions, I want to close up today. This presentation will be presented on YouTube, and there's slides at the end that show people how to get in touch with both Prairie Hill and Exeter Trust Company. Throughout this presentation, you heard us all mention the word diversification, probably between 40 and 50 times, right? And I think when people think about diversification these days, they think, well, I'm going into some quantum computing stocks. I'm going into some mutual funds. I'm going into some semiconductor stocks, right? So I'm diversified. Here we're talking about real diversification. It's fine to have an equity listed portfolio, but when you go into real estate, either direct or when you exchange into a tenant in common relationship with a professional manager, or whether you hold a private real estate fund in your IRA, you are diversifying into asset class, right? And that affects your risk return potential. However, you're also diversifying differently. You're diversifying into management, into private fund management, which means additional focus, additional experience, additional engagement. And that's very important. People forget that diversification means many different things, and diversifying into private, fully autonomous managers is very important to retirement plans, as well as non-qualified vehicles as well. So we will close up shop today. Thank you, Prairie Hill, for joining us. Outstanding presentation, and thank you for everyone else out there who joined us.